I just couldn't wrap my head around the fact that I had to research for 3 or 4 months to find the best lender. So you have to pick up the phone, you have to call to one broker, to another broker, you need to call to many banks, local banks, regional banks, credit unions, and so on, and try to compare everything and decide what's the best for you. And I just wished I had something that I can just go and put all the filters I want to and get the kind of a simple order or arrangement of which banks I should work with.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Ari Shpanya is the co-founder and CEO of LoanBase. Ari, welcome to the show.
Thank you for having me, Sam.
The pleasure is mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Okay. I started by buying a single family home. I lived there while I was attending actually a program at Stanford. And then I remodeled it by myself. From there was one more. And that's how you get to multifamily, I guess. But it's always about humble beginnings, and I think I'm still at the beginning.
Interesting. What do you do now at LoanBase?
Oh, on a high level, LoanBase is a kayak or Expedia for commercial real estate loans and investment properties. We help investors and borrowers to find the best loan for their needs by searching in a very easy and seamless way, just like you shop for flights on Skyscanner or Kayak or Expedia.
That is really interesting. I guess, tell me, how did you know, or what hole did you see in the market where you said, man, this is something I need to create? And then I guess we'll start there. Let's ask that question first. I want to ask you too many all at once.
Yeah. Definitely. I remember a couple of years ago, that was during just a few months after COVID hit. I needed to refinance a couple of properties in San Francisco, multifamily. It was a $10 million loan for both of them. And I just couldn't wrap my head around the fact that I had to research for 3 or 4 months to find the best lender. So you have to pick up the phone, you have to call to one broker, to another broker, you need to call to many banks, local banks, regional banks, credit unions, and so on, and put all these little notes and comments, and then try to compare everything and decide what's the best for you. And I just wished I had something that I can just go and put all the filters I want to and get the kind of a simple like a order or arrangement of which banks I should work with. And the same was for the process of underwriting and during underwriting and during that process with the bank, it was like pulling a teeth, right? It was really 3 months, and you feel like you're being asked for so many documents, but everything goes by email. So it was really horrendous. So I remember actually finding out by the broker that the broker is actually making another yield spread on my deal. So not only did you pay a broker a fee, you're actually paying someone a fee to give you a deal that is better for them rather than better for you. And I was really upset. So I remember calling the broker and telling him, listen, this is not okay. This is not fair. Here's what I'm going to do. I'm going to start a new company and put you out of business. So, yeah. Jokes aside, that's kind of what happened. And, it was a result of a real pain of 4 months process that should be less than a week.
Yeah, I love stories that start that way, because it's like, you know what? You saw a problem. You said, I can solve this in a more efficient manner. How do you stay in front? So you guys aggregate, like you said, you're the kayak for loans. So, I mean, I can understand it from the airline's perspective, where it's like, hey, you know what, here's our flights that are available, and they can probably integrate their data, or they do integrate their data some way such that it can be displayed on Kayak. But how do you guys stay in front of what each lender is offering, the terms they're looking for, the money they have to lend? I mean, that's got to be a constantly, especially right now, moving target. How do you guys stay in front of that?
Correct. So there are 3 ways that we do that. First is we have banks that are our partners, so we get their rate cards and rate sheets, and essentially we scan them, and we do what's called an auto parsing. So we scan the rate cards, and that is being inputted to our database. We also talk with the banks to verify that. So that's part of data integrity. And some banks, some lenders, we also have a direct integration. So that's another way to get the data. The rates are changing. We also have some proprietary algorithms that essentially are looking into the Fed rate, the Treasury, the T-bond, 10-year, and calculating based on the rate fluctuation. So if the Fed rate is increasing today, obviously the banks will follow. There is a difference between regional banks and national banks and debt funds. So some banks are more less susceptible or less sensitive to any kind of change in the Fed rates because they were lending off their balance sheet. But most shops, debt shops, and so on, they will be in line with that change. So we add that spread or that change to their rates, and that's what we present to the consumer at the end of the day or to the borrower.
Tell me about building your company. I mean, okay, so you got this great idea. You figured out how to integrate the rates from the lenders. And now you said, all right, the next thing I need is clients. I mean, you need somebody to come to you and work with LoanBase. What was that process? Because we talk a lot about on this show of scaling your business, scaling, real estate. What was the process for you for scaling LoanBase?
Yeah, it's a good question. Initially, we're relatively a new business. We've been around for the last 18 months. Out of that, probably 12 months in beta. So it's really important to nail down your product to give a good experience to your first customers. So we still in this kind of stage. We still working mostly based on referrals that we get on friends, clients that refer other clients. Obviously, we do get some by paid search or by anything of like content or articles out there. But at the end of the day, I really think that if your product is good and product-led growth is the best thing, because then it becomes viral, or at least one happy borrower can tell their colleague. I'm sure that you have a lot of people you work with. So if you're happy with a certain product or a certain technique, then you're definitely going to share it with others. And that's the best type of marketing, I think, in our industry and in general.
Got it. No, I think that's really, really cool. Tell me your general feeling. I mean, you're involved in the financial markets. Where are we? Where are we going? How should borrowers be protecting themselves? What steps should they be taking right now? I guess just give me a kind of holistic view, if you will, on where we are and then what people should be doing.
Yeah, it's interesting that you ask, Sam. I've just seen today one of the latest surveys and very thorough research reports, and it seems like there is a consensus among the U.S. consumers that this is one of the worst times to buy a home, or at least that's, as opposed to last year, we can really see that decline. And obviously, with combination of increasing interest rates, it's really something that might be alarming. So we are potentially heading to recession. Obviously, the Fed is going to try to make sure that we are not going to hit there. But in terms of interest rates, we are seeing in our industry, right? We are seeing the interest rate are going up. We see that across the entire markets, including secondary markets. So right now, if you're a real estate entrepreneur and you're getting a hard money loan for, it can be a rehab, construction, bridge, entitlement, land entitlement, you name it. You used to get it for 7.5, maybe 6, maybe even 4.5 if you had a good relationship with your local bank. Now it's close to 10 and 10.5. So it's really not sustainable. It's really that service coverage ratio is just completely being destroyed, if I may say. And that will create, in my opinion, more defaults, because if you're in a project already, that's fine, but it will be very hard to get that takeout loan. And if you're starting a new project, then all the lenders are essentially underwriting to new guidelines. And new guidelines means that there are no more takeout loans at 4.5. Again, I'm not I'm putting aside the relationship discount and so on. But most debt shops are underwriting to, an interest rate of 6.25. So that means you really need to have a very profitable project. I think we're going to see a lot of foreclosures. I think we're going to see a lot of projects going to default. That's going to create more opportunities. Cap rates, we see that is being pressured. So this is the end of the cycle, just like 2008. So there are winners and losers. So I think it's a good time to have your war chest and be ready for gobbling up some inventory that will be distressed. If you are the investor, you do want to be very cognizant and conservative. Definitely not over leverage. Always go in I would say 65 to 70% LTC leverage, not over leverage yourself. Better to have more equity in the deal. This is not the time to optimize for your profit. This is the time to optimize for your reputation and your deal to survive.
That is really interesting. What you say there. I think that's sound advice. It is not time to optimize for profit. It is, that's absolutely great. Tell me about this. You think the foreclosures are will be on the rise because if people are mid-project and like you said, they need a takeout loan or they need to recapitalize, they are not going to be able to refinance at the rates that maybe they underwrote to. Is that what you're saying?
Yeah, exactly. I mean, look, the inflation, when the inflation is going up, right? So you have a certain pressure there. You have an interest rate that's going up. At the end of the day, that is pressure that creates some pressure on the cap rate. So we see cap rates are going up as a result. We see on a higher interest rate, we see a debt service ratio that is really hard to reach. So we see that usually banks will need 1.25 at least, but a project that used to be 1.25, 1.35 is all of a sudden below 1, which means it cannot serve its debt.
Right.
So in that case, it does create that pressure, and some entrepreneurs, they may they may end up in default, or they may need to bring more collateral and so on. I remember something that happened to me. I'm as a real estate investor in the past and present. During COVID, I had to bring more liquidity to the deal, because at the end of the day, with this space, you really want to make sure that you have no single bad apple. You always need to have an impeccable track record, because your record is everything. And you need to make sure that no deal goes bad. That's why you want to go low leverage. That's when you want to add and have the interest reserves. But I definitely think that there's going to be a lot of opportunities with these assets that are just not a lot of single family homes that are going to drop in value. A lot of other asset class that's going to come down in value. And when they cannot serve the debt, then that might create an opportunity for other buyers, so that's kind of where we are.
Term conservative underwriting is something that is thrown around all the time in our industry. We always underwrite, super conservatively, which to me, it's when you ask somebody how you doing, they're like, oh, I'm great. It really doesn't mean much. It's okay, yeah, sure, you're right, conservatively. When I say conservative underwriting, what should people be doing if they are projecting a cap rate at exit? How can they do that conservatively? What should people be plugging into their charts in order to say, hey, you know what? I think we've really been hyper conservative in our underwriting when establishing our cap rate at exit.
Yeah, it's a good question. From what I see with our lenders, we have visibility to thousands of lenders. So I can tell you that conservative underwriting starts with conservative rent projections, for instance. So let's say on multifamily, let's say we're in LA or in San Francisco, where we're looking into market rents that we have to take into account, and let's say assume 80% of the current market rate, right? So we want to be conservative on the market rate. We want to be conservative about the vacancy. So we want to be conservative about the other costs, like the cost to manage a property. And that's one aspect. Then you want to be conservative about the cap rate. So let's say if you're in, I don't know, let's say if you're in LA or in, then it will be, I don't know, it used to be 4.5 cap, and now you're going to underwrite to 5.5, for instance. So that's another thing. And then a third layer would be the debt service coverage ratio. So it's actually, you can increase that. So rather than 1.2, you can go to 1.3. And the last thing I would say is take into account the interest rate that could be in a year from now, and that's not necessarily a lower rate. So you have to be, planning for, hoping for the best and planning for the worst, essentially. So that's how I look into performance of other lenders, and I just see that everyone are definitely doing that, and everyone are also reducing their LTV or LTC. So lower loan to value. Right. Used to be 80%, it dropped to 70. LTC used to be loan to cost 90%. Now we see it at 80 max.
Right.
And I see now what's called an interest reserve. So 12 months of the interest reserve holdback. Okay, so that's money that you bring up front to the deal, especially on the construction deals or rehab deals. So all of these are essentially steps that lenders are taking in order to make sure that you bring the project to the finish line, because no one wants to get stuck with a construction project, right? So
no, certainly not. Certainly not. What is a practical piece of advice that you would give to somebody that's looking to, let's say they come to your platform, but what's one thing that they should be doing as a borrower that would set themselves apart and make getting approval on their loans easier?
The thing about real estate investing is it's kind of has the compounding effect, right? So the better borrower you are, the better track record you have, the better access you have to rates, the better access you have to capital, the better access you have to investors and inventory and so on. I would really say it's important for borrowers to focus on having their experience with 5 properties, 5 assets completed. So that's something that every real estate investor, every real estate borrower should have under their belt. And once you have this experience, and it relates to what we talked in the past, it's okay that you didn't turn a huge profit. It's really important to establish your credibility and your experience. And even if you made a 15% IRR or 25% IRR, it doesn't matter. Even if your LPs made more money than you, that's totally fine. As long as you have these 4 or 5 projects in terms of experience under your belt, and then you're golden, because that's what you need. You need that 4 or 5 buildings in terms of experience, assets. You want to have above a certain credit score, which is not an issue. And you want to have a certain net liquidity, which is also something that, you want to set aside something and never be over leveraged. So these are the 3 golden rules, or the rule of thumb, that I would say for getting a loan today, or getting financed. And I would say that's a key here.
Fantastic. Ari, thank you for taking the time to come on the show today and really give us your view on where we are in the market cycle, what's going on in the market, and then really telling us, how to be prepared as a borrower when we come to, come and talk to the lenders, and also just, tell us about LoanBase and why you started it, the problem you saw in the marketplace, and then how you creatively solved it. I think that's really, really cool. Certainly appreciate it. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
LoanBase.com.
LoanBase.com. Fantastic. We'll make sure we put that there in the show notes. Ari, thank you again for coming on today. I certainly appreciate it.
Thank you, Sam. It's been a pleasure.